Arvind Sanger is managing partner at Geosphere Capital Management. He's joining us right now. Arvind, great to have you on the program. Thanks very much for your time. You know, it's always something, right? Almost a fortnight of a flattish, sideways kind of trade here in India. And then you have Reliance, which kicks in. And then, of course, IT services. But I just want to start with IT services. I don't know if you managed to see any of the results. But, you know, it's not as if numbers have suddenly started to show great signs of enthusiasm or anything. It was just that third quarter is seasonally weak and numbers were a little better. But growth is like 1% quarter-on-quarter constant currency, between 1 and 2.5 odd percent, right? So it's nothing very large, but stocks reacted in a very outsized way on Friday. What are your thoughts there? IT to many is still a macro call, a US macro call. Your thoughts, Arvind?
Well, it's interesting. I was talking to a US IT services company CEO, and it was interesting. He was lamenting the fact that he is listed in the US because for the same growth, his multiple would be twice that if he were listed in India. So, you know, I think what you have is a much more euphoric valuation setup in Indian market for the same IT companies with similar growth drivers. So, I mean, I think there was absolutely nothing that you could take as a great positive when headcounts are reducing at both TCS and Infosys, but the market is just chasing after laggards. So, you know, this is a market that has got the bull between its teeth, and it's not letting go. And I think we can always make up facts after the fact for why the stocks went up. But the reality is that, you know, I didn't see anything dramatic that would account for that strong move in IT last week.
Okay, got it. We have banks in focus this week, and HDFC Bank comes out with their numbers tomorrow. What is your expectation from the private sector banks this time around? And as an investor, would you put any fresh money to work here? Would you be cautious? What's your stance?
Well, I think on the banking sector, the main challenge is going to be if loan growth keeps exceeding your deposit growth, then that acts as a long-term challenge to being able to sustain that growth. So, you know, I think the balance sheet problems are not there in terms of bad debt issue. It's more getting deposit growth to match up. So I think we'll be looking for more signs and commentary from the companies as to how they're managing that loan to deposit ratio challenge, because that can get too far out of kilter. I think the banks have, you know, a strong growth opportunity ahead of them from a loan growth demand standpoint, and the quality of the, growth that is coming, although there's a little bit of a risk that RBI has raised risk weighting on unsecured loans, but at least on the secured side, things look good. But I think the main challenge is going to be on the deposit growth side. And so that's where we'd like to see a little more momentum.
Hi, Arvind. Good morning. Arvind, the last week or so, you got some sound bites coming out of the Fed officials. And maybe, in fact, the street is pricing in too many rate cuts and maybe too fast. How do you read that, point number one? Point number two, the geopolitical space is getting a little uncomfortable, right? The markets have been ignoring it. But at some point of time, it's going to affect trade. It's going to affect economies as well.
Well, I mean, I think you're spot on because, one of the things that people are not commenting on is because of the tension in the Red Sea, because of the Houthis, you have seen a doubling of container shipping rates. The Shanghai Container Freight Index has more than doubled since late November. And again, if this is temporary, it's fine. But if the Red Sea remains a place of tension and shipping remains diverted for an extended period, that is going to start feeding into, in consumer inflation in the US and elsewhere. Europe is actually even more hard hit. And if that happens, then the expectations that the Fed and the ECB and others are going to be cutting rates aggressively may get put on the back burner. And I think the markets have kind of gone all in into this assumption, although I guess there was a little bit of a pullback, at the start of January. But the markets are still relatively benignly focused on rate cuts by the Fed starting as early as March. And so I think, yes, that is definitely a thing to keep an eye on. But the good news is that oil, despite all these tensions, has remained well behaved. Yes, it's come off the bottom, but it's only at $78. It was, low 70s a few months, maybe a month ago. but it's only 78. It's not in the 80s and 90s and 100. And that reflects the fact that there's a lot of spare capacity in Saudi Arabia and other OPEC countries, and therefore the market is not tight. So as long as oil remains well behaved and we don't get too much of a consumer inflation, maybe this Goldilocks scenario plays out and Fed is cutting rates by March. But I think that is one of the risk factors in this kind of benign assumption that liquidity is going to be rampant and everything is going to be hunky-dory in 2024.
All right, we'll leave it at that. Arvind, thanks a lot for joining in. We'll let you go and enjoy the rest of your week.